Hi, we'd like to welcome everyone to today's webinar, Asset Protection Strategies and Tax Planning under Biden's Pre-Election Proposal. Just a couple of housekeeping pieces before we get started. So we're going to be taking as many questions as we can at the end of this. So you can go ahead if you have questions throughout the webinar, you can type them in. If we don't get a chance to answer your question on the webinar live today, we'll make sure that someone from our team does get back to you with an answer. So feel free, as many questions as you have, go ahead and put them in there. On our panel today, we have Henry Rinder. Henry is a licensed certified public accountant in New Jersey and New York with more than 30 years of public accounting experience. We also have Christine Malilly. Christine is a manager of the firm who is a licensed certified public accountant in New York. She's also licensed to practice law in New York and New Jersey. And we also have with us today as our special guest, we have Natalie Goldberg, who is a celebrity wealth attorney, business strategist, and managing attorney of Goldberg LLP. So Natalie comes to us with a lot of celebrity appearances. She's appeared on shows like CNBC, Fox News, CBS, BBC, Good Morning America, and she's also been featured in articles such as CNN World, Parents Magazine, and Star Magazine. And with that, I will pass it along to Henry to get things started today.
Thank you, Amanda. I am so delighted to have both Christine and Natalie as panelists today because they are true professionals and super smart, and we're going to learn a lot. And we're getting a pretty good attendance. The topic's obviously pressing. We're talking about year-end strategies, and as you can see on the agenda, we're going to be addressing what President-elect Biden was proposing in terms of changes to the tax rules. And we would like to consider and reflect on what actions you can take now, and a lot of these actions would have to be taken before the end of December to protect your assets and to minimize your income taxes. And as well as we're going to be addressing some of the strategies that have to do with estate strategies and planning and minimizing estate taxes. So without any further ado, I'm going to go to the next slide and turn over to Christine, who will give us sort of an overview of what to expect. Christine?
Hi, thank you, Henry. Everybody you can hear me, right, Amanda?
Yes, we're good.
Okay, good. All right, I'm Christine Malilly. I recently joined Small & Lupin as a tax manager. I am really, really excited to have this opportunity to present to you today a tax legislative update, given that we have a new administration coming in. And I'd also like to look ahead to the 2021 and 2022 tax years for some potential tax planning opportunities. And so now, we only have a short time together, so I know I won't be able to cover every area of the tax law that I believe could be impacted, especially in the arena of international tax. So I've gone ahead and cherry-picked areas that I've deemed most applicable to the audience today, and I've coupled that with what, in my personal opinion, is more likely to occur. Because as we know, getting legislation passed is like picking from an a la carte menu. You get one from side A, two from side B, and so there's definitely some uncertainty there. So let's get started on this first slide that we have up. Now, I'm a tax person, and I'm sure there are many of you out there that are as well. And so as tax professionals, we know the whole world revolves around taxes, and in fact, it does. But in case anyone out there is not convinced that a new president would focus on a tax bill, this slide will show you that historically, every single president in recent history since President Reagan has enacted a tax reform bill in his first year of his first term of presidency. And so we should expect President Biden to do the same. Now look, hands down, tax is the most useful tool to getting policy pushed through. In other words, tax legislation can be used as a means to an end. Now, historically, the Republicans have focused on tax reform, but the Democratic administrations have used taxes to fund other policies on their agenda. So if you look at the bills listed here, not all of these bills listed on the slide were tax-centric, right? Rather, they included a piece of tax legislation and carried a big tax title. And so if we look at where we are right now in the middle of a pandemic, we should probably expect the Biden administration to enact some sort of COVID relief bill, which will no doubt include tax policy. Now, the big question this year is how likely is it for a Biden administration to actually get anything done? And something I want to point out, is probably most everyone on this call is aware, is the current makeup of the Senate and the two runoff races we will have in Georgia on January 5th. If the Republican Party is able to win just one of those two races, they will have a majority of seats in the Senate. And so this begs the question, in the case of divided control, how likely is it for the Biden administration to actually get anything accomplished? Well, the last time an administration was able to get a major tax bill passed with divided control was in 1989. So every bill since then was passed with single party control. So even if you're thinking it's not an impossibility, since both Presidents Reagan and Bush Sr. were able to get that done, I would say that the world was a much less partisan place back in the 80s. So I think it's safe to say that if the Republicans maintain a majority in the Senate and we have divided control, it will be a challenge for President Biden to work with Majority Leader Mitch McConnell to see if they can come up with a bipartisan deal on a tax bill. So let's move to the next slide. Thank you. So given the current state of the Senate, what can we expect? How can we plan? What can we expect on the immediate horizon? So here are some provisions that I think will require some action regardless of how the Senate shakes out. If we look at the first three boxes in blue, these are extender items that are set to expire as part of the CARES Act. And the green boxes to the right, those are items that were enacted as part of the TCJA, and they're set to expire soon thereafter. So it seems to me that some of these things are going to have to be dealt with this year, no matter what happens in the Senate. So let's just take a look at the blue boxes first. We have the 50% interest limitation, the NOL carryback suspension for corporations, and the excess business loss limitations on the individual side. So the question is, given where we are in terms of the pandemic and the economy, can we expect a bipartisan deal to get done with any of these? I personally would not be surprised if we see the 50% interest limitation being extended, since this provision, it encourages companies to borrow and leverage and to stay afloat. And, clawing it back would just be in conflict with that policy. And quite frankly, I think a slap in the face for those business owners who did everything that they could to stay afloat. But I could see the NOL carryback and the excess business loss limitations just running their course and expiring. Democrats have expressed pushback on each of those, and they pretty much view them as benefiting only the wealthy, whether you buy into that or not. But to shift over to the green boxes, we have the expiration of the TCJA extenders. Now, of these five, I think we could most likely expect bipartisan support to extend the first three. That is an increase in the interest limitations, going from an EBITDA standard to a harsher EBIT standard. And I think that one would be extended for the same reason as the 163J provisions will be extended. The second is the ability to write off certain research and experiment costs immediately, such as engineering costs. And the last is the 100% bonus depreciation rules, which will begin to phase down at the end of 2022. I do think those three will certainly get a hard look and could be extended even in the case of divided control. Who knows? If bipartisan support can be achieved in these areas, maybe it can open up the doors for continued bipartisan consensus. Something I do want to note with the last two green boxes, they are both set to expire New Year's Eve 2025. And while this may be kind of around the corner for tax planners, it really is a lifetime away for Congress. So I would not expect these last two boxes to be a priority. But I will say that fourth box, dealing with individual changes, that's a hot topic. That's where that SALT deduction of the $10,000 cap is bundled in. And Democrats are not proponents of that $10,000 cap. And quite frankly, President-elect Biden has been quite vocal about not supporting the TCJA as a whole. But take a step back. The reality is that the Biden administration, it doesn't have to do anything. And everything you see on this slide will just take care of itself and expire, even if nothing's done. So let's move on and let's take a look at some of President-elect Biden's individual tax proposals. So there's been discussion about increasing the top rate on ordinary income from 37% to 39.6% for those making more than $400,000. This was the magic number in the Obama era for who was considered wealthy. Further down the list, that's that third bullet. Okay, something that's not been widely talked about has huge implications is the subjecting of wages over $400,000 to OASDI. So currently, OASDI withholding turns off at about $138,000. So this would turn them back on once wages get to $400,000 with no limit. So if you're self-employed, that's 12.4%. If you're an employee, you'll split that with your employer. I will say table that. I want to circle back. There's a reason why it's not getting a lot of attention. So I am going to come back to that in just a moment. Right below that, this is a good one. Impose a limit on itemized deductions to 28%, no matter what bracket you're in. So if you're in the highest tax bracket, your itemized deductions are going to be limited to an effective rate of 28%. A really big one, getting a lot of attention, is on the investment income side. So raising the rate on investment income for high income individuals to be equal with ordinary income. This is what Democrats are calling treat wealth like wages. I think this will be very difficult for the Democrats to get passed through, but there is a lot of talk about it. Lastly, I want to make 2 points on the estate tax side. The first is lowering the estate tax exclusion from the current $11.58 million to $5 million. That would be in line with the Obama administration. And finally, our real biggie is eliminating the free step-up in basis at debt for capital gains and forcing people to have a realization upon death. I want to just take a quick look at this. When we combine the elimination of a step-up in basis at death with the potential for cap gains rates to increase to 39.6%, then you layer on the net investment income tax of 3.8%, plus lowering the possibility of the estate exclusion to $5 million, and forget about gifting your grandkids anything and being subject to the generation skip-in tax, you could actually pay a 100% tax rate. Now, although each of these proposals, they stand on their own, you could see a perfect storm in the case of all of them being passed. I don't want anybody to get too nervous. It would be very difficult for all of that to pass. But I did want to point it out because these are items that certainly would need to be considered for planning purposes. In addition, I want to circle back about those OASDI wages. The only way Democrats could get that to pass is through the filibuster. Since this deals with Social Security, it cannot be part of a budget reconciliation. So some of you may be aware that President Trump got the TCJA passed through a budget reconciliation. Social Security is off the table in a budget reconciliation. So again, even if the Democrats win the 2 Senate seats in Georgia and Kamala Harris winds up with the tie-breaking vote, it's going to be very, very difficult for the Democrats to get anything done without bipartisan consensus. So I would say, in my opinion, the most doable item on this list for the Democrats would be raising the rate on ordinary income from 37 to 39.6%. I just think this will be the easiest one for them to get buy-in on. Okay, I'm trying to move quickly in my short time. Let's go to the business Biden plan. Next slide. Okay. So we have the corporate rates going from 21 to 28%. This one is key. New minimum tax to replace the old corporate AMT that was previously repealed. A phase out of the QBI deduction for individuals making $400,000 or more. Not all bad news. There would be a new tax credit, possibly for manufacturing facilities. So for those who invest in CapEx, the building out of facilities, they would get a credit. On the international side, for anyone doing business outside of the U.S., the current GILTI regime would double from 10.5% to 21%. But also, there's actually going to be there would be changes to the deduction basket, so the effect would really be more than doubling the rate. And then there's talk about denying deductions and penalizing companies for moving jobs overseas. Some other items at the bottom of the screen that the Biden campaign has stated, but by design has provided no detail on. They're looking to impose a tax on large financial institutions, repeal fossil fuel incentives. So that's geared to the oil and gas industry. This one is interesting. Impose some sort of tax increase on real estate investors, such as limitations maybe on real estate losses, or maybe the elimination of Section 1031 like-kind exchanges, or both. So I said not much out there on these items, so we'll have to keep a close eye out for any development. I would say as far as the items on this slide go, the easiest lift for the Democrats would be raising the corporate rate to 28%. But I do think that we're going to see a corporate min tax. I think that's something that we'll see because it only affects profitable businesses. I could see bipartisan consensus there. So that's how I feel about that slide, but more to come, I guess. So I have one more slide to speak about. We could just move on to the next one. Okay. So I've listed out here a number of proposals that were not enacted under the Obama-Biden administration. So as I'm watching President-elect Biden appoint his cabinet members, it looks all too familiar. And so in my opinion, it's quite possible he's going to look back at some of the proposals that President Obama had. Now, there's definitely no guarantee that these will come up, or if they do, even, be passed. But it's possible that they might. So I'm not going to go through all of these. They're really for you to have as a point of reference. But I do think I'd be remiss if I did not point out the second bullet dealing with the 2704 regs. The reason why I just want to talk briefly about the 2704 regs is really twofold. First, I think it's applicable to the audience on this call, but also it does not need congressional action like the rest of the items. This is the easiest item on this list to get approved. So what 2704 does is it limits or eliminates the availability of valuation discounts for transfers of interest in closely held businesses to family members. And this began as an idea in the Obama budget book, and then it disappeared, and then it reared its head again when the proposed regs came out in August of 2016 under President Obama. And in November of 2016, President Trump was elected, and by April of 2017, President Trump issued an executive order mandating that these regs, along with other regs, all needed to be reviewed. Ultimately, the 2704 regs were officially withdrawn on October 20th, 2017. And so why do I bring all this up? Well, essentially, these can be dusted off and put back into play without congressional action. So if you are interested in gifting closely held entities to a family member, this is something you want to factor into your analysis. So with that, I'd like to turn it over to Natalie, who is going to provide us with some strategies that can be implemented now, taking into consideration what might be on the horizon.
Thank you for that, Christine. And Henry, thank you for having me. I'm putting my video on because when we talk about estate planning, I hate that brand, I hate that term. We're not talking about what happens only at death. It is your life and legacy plan. And we have brilliant people like Henry, like Christine, and we can run the numbers. We can see to the penny, what are the tax ramifications? What are the dollars and cents? But the number one most important thing that people get wrong is not that their plan didn't work as well as they thought it would. It was that they didn't have a plan to begin with. So very common sense, easy thing, get your plan in place. Get a plan. And here's the deal. A lot of you are probably laughing, or at least I hope so. The fact is 64% of people in the US die with not even a will in place. That is 200 million Americans. And I'm willing to bet that some of you on the call are very successful in real estate, in business, etc. And you have been spending so much time running on the wheel of making the money without really considering what will happen if and when. And we hope that when is many, many moons from now. However, we have to be cognizant of what happens if, heaven forbid, COVID is caught and really doesn't go well, or there's a car accident. We always talk about the so-called bus that hits a person and that's it. We need to ensure that we have a plan in place. What does a plan consist of? A great tax strategy, of course, and a life and legacy commitment to your family. We're all on this call today because we love somebody. We care about somebody being taken care of when we're no longer here, whether that be our children, our siblings, our charities, our businesses. So we owe it to them to have a plan in place of, here is my constitution, here is my legacy, which by the way, you get one shot at. You can either leave excuses or legacy, not both. You get one shot at it, and here is how I'd want to be remembered. You get to define it, or a judge who's never met you gets to define it. You choose. Next, it's a lot of people, not who work with my firm, because we are very much hands-on white glove service. Many people go to an estate attorney, or they go on LegalZoom, God forbid, and they print out a will and trust. And what happens to the trust, as I'm sure the other professionals on the call will agree, it never gets funded. So let me make a very, very clear and very simple, forgive me if it's too simple example. Here's my boss lady mug. It is my favorite mug ever. It's a great mug, beautiful, etc. That's the trust. Beautifully written, great provisions, tax beneficial, fabulous, mwah, mwah, mwah. But here's the thing. I can't drink coffee out of my mug until I put the coffee into the mug, to the container of the trust, and fund that trust. Many of these plans fall apart because with all the great planning the professionals do, the client then gets a funding letter. Client, I know you're busy, but here's the deal. Go to your 17 banks, change the names, change the beneficiaries. Here's where we're going to structure it. And the client says, yeah, that sounds good. I don't know what they're talking about. They don't do anything. We cannot let a great plan that you have spent money on go unfunded, because then it's a worthless piece of paper. Okay? The next thing is people are always talking about marriage. Is it worth it? I want to have my life. I want blah, blah, blah. Look, in today's society, staying married has a very specific amount of money associated with it. And that is $11.5 million, which is what we get to use of our spouse's lifetime exemption and estate exemption upon death. What does that mean? I'm married to Sam. Sam and I each have an $11.5 million sticker on us today in today's tax world. We combine that to close to 23 million we can send down to our children estate tax free. What is being proposed is that $11.5 million sticker I wear to be reduced to 3.5 to 5, depending on where we're seeing these proposals that Biden has come out with. Now, a lot of people might say, okay, now I have an issue because 7 combined with a 3.5 each is a lot less than 23. But here's the second thing. Typically, on the first spouse to die, people don't know what to do. So what do they do when they don't know what to do? Nothing. And if you don't take advantage of that first spouse to die's exemption, you could lose it. Now, in a Biden administration that has said that they're going to significantly lower the amount of money you can pass estate tax free, and have said that anything above that exemption amount would be taxed at a 70% rate, we have to be very careful about, first of all, how's our marriage working? Are we going to be able to really pass both exemptions down? Are we going to be able to take advantage of both of those things? And a lot of people, maybe you hate your spouse. Maybe you say, you know what, as a business deal, that's not a bad business deal to have, to say we can live separate lives, but for the kids, we're able to do this. This is something to consider if anyone is considering not being married anymore. So I say tongue-in-cheek, stay married. The other reason I say it is because according to a Bloomberg article, and we've been doing this planning at my firm for a long time, we're using this sexy thing called a Slat, Spousal Lifetime Access Trust. Now, you might hear attorneys in this world talk about the alphabet soup. Slats, grats, grits, what the hell is going on here? Nobody understands. Here's what you need to know about the Slat. You can gift to your spouse, and in their trust, right? So we would structure it. Let's say in a recent example I did, the male in the family, the husband, is the one who has made a tremendous amount of the money. Wife is establishing a Slat for his benefit. She's the grantor. The grantor means the person establishing the trust. He is the trustee, the person in control of the trust, and the initial beneficiary. So as a result, with proper structuring, we're able to have, let's say, 5 million go into that Slat. We're going to file a gift tax return, and We're going to allow husband, who's anyway the one doing the money stuff, to still be in charge. He's the trustee and beneficiary. And guess what? If he continues doing what he's doing in the stock market, that 5 million he knows is going to grow likely to 30 or 40 during the course of his life, God willing, if he lives, 30 or 40 more years. Well, all of that appreciation is now outside of the estate because of the gift of 2020, which we took advantage of. So this has been a tough year for many. Let's take the gifts that we do have and take advantage of them. Next slide, please. Now, I want to bring you to this great titan of industry, John D. Rockefeller. He said very specifically, own nothing, control everything. Why? Beyond the taxes, people, the biggest threat we all have is a lawsuit. There are a lot of brethren, colleagues in the legal profession, who they make money suing people, period. They're looking for the bullseye on the back, the very successful real estate owner or business owner, to make a mistake so that they can latch onto anything and get your money. Now, I don't know about you, but my hard-earned money I want to ensure is there for the right people and not for a would-be creditor. And in today's litigious society, we cannot be too careful. If you own property in certain entities, such as LLCs, domestic asset protection trust, DAPs, which I wrote on the bottom of the alphabet soup in certain jurisdictions, you can now rest easy knowing that even should a would-be creditor come around, you can tell them, get lost, see you later, you're not going to get a dime from me, which you bet will allow for a lot smaller settlement negotiations on your behalf. So whether or not Georgia goes red or blue, and the tax ramifications, of course, the taxes need to be understood and need to be planned for. This is a huge opportunity. But beyond that, we want to ensure that where our legacy is not of a lawsuit that ruined us, God forbid. It is rather one of controlling the entity, allowing it to grow for future generations, and protecting it. Because what is the use of working so hard if we're just, not taking the steps to build that foundation of our house? Next slide, please. Okay, so that is what I have to tell you. If you can remember one thing from what I spoke to you about it, we have one shot at our legacy. The tax is a very important consideration. We have a huge opportunity right now. And I would also suggest that you consider strongly how you are protected going into the future. God bless you all, and I hope you're all safe and healthy through this holiday season.
Thank you, Natalie. And I'm going to jump right onto the last slide. And the basic objective here is, what is it that you can do before the end of December, frankly? And just knowing what I'm facing as a professional and what my partners and other professional staff at Smolin is facing right now is with clients. We are definitely addressing a couple major items that are not on this slide, and I want to bring that up because they are pressing. So one of the issues is, how are we dealing with something called business alternative income tax, which is a law that got passed in New Jersey and some other states, which allows pass-through entities to deduct income tax that's attributable to the income of those entities at the entity level, in effect circumventing a state income tax deduction limit of $10,000 on a personal individual income tax return. So New Jersey has provided a way to do this. It's not without some complexities, because as far as I know, even as of yesterday, they still didn't have the forms out in paper. It's all done on the website. So I would encourage everyone that is showing profits in 2020 in the pass-through entities to immediately speak to their professional tax advisors If you are a client of Smolin, please reach out to your Smolin professional and make sure that this is getting addressed. The taxes have to be paid, and they gotta be paid on the corporate or on the partnership level, and that will give you a deduction, frankly, which would otherwise be limited. The other item that's not on this agenda, on this slide rather, is the issue that has to do with the payroll paycheck protection program and the deductions that are attributable to the forgiveness of the loan that our clients and other businesses have taken through SBA program and through the banks. And the Treasury and SBA are on the record that those deductions are not gonna be deducted for income tax purposes, which is again giving us as professionals and clients some concern. We need to address it. We need to address the timing of these deductions. You have clients and businesses that have fiscal year ends, which causes some additional concerns. And again, I would advise that you reach out to your Smolin professional. And if you're not a client of Smolin, reach out to your tax advisors. This needs to be addressed sooner rather than later. You need to know where you stand in terms of deductibility of expenses that are attributable to the forgiveness of the PPP loan. And as far as other items, the normal strategy for businesses in situations as we are facing right now, where a new administration is coming in, proposing higher taxes on income, proposing higher capital gain taxes, would be to, if you can, speed up recognition of income, speed up recognition of capital gains, and delay deductible expenses into the future year. So if you have that flexibility, if you have that ability, that's something to be considered with your tax advisors as well. And obviously, the timing of your capital gains, if you talk to your stockbroker, if you talk to your investment advisor, they may suggest some last-minute corrections that can be done with your portfolio to basically improve your tax situation for 2020 and 2021. And you should take advantage of it before the end of the year. Likewise, if you're thinking about some charitable contributions, this is a good time to think about it. We have here listed a lifetime charitable remainder trust, which is something that you might consider, and I'm sure somebody like Natalie can help you out with setting that up. That would be basically private to you, or you can call your broker, your wirehouse, your investment advisor. They might put you into a charitable fund where your contribution to it would be deduction in 2020, but then you can, in the future, designate the various charities to which you would like to actually give money to. And so you're accelerating a deduction without actually immediately committing to where the money is going to go. And Plan 529 is still very much in play. So is your 401k plan. In that regard, you probably should talk to your pension actuary or your pension specialist if there is a way to increase the amount of contributions. You may want to consider that. Likewise, going the other way, if you have IRAs, maybe this is the time to, if you are in position to do it, to take some of the IRA distributions, accelerate the income from the IRAs, and perhaps you're going to have the ability to roll over into a Roth IRA, which we would hope that would remain tax-free, both in terms of appreciation, interest, dividends, and future distributions. At this point, I think I wrapped up what I wanted to wrap up on this slide, and I'm going to turn over to Christine for some final comments regarding today's presentation. Christine?
Okay, thank you, Henry. That was very helpful and informative, and I'm sure many people on this call can appreciate those recommendations. So I just want to leave you with a parting gift. In Italian families, the only thing that matters when you leave the party is the party favor. We call it a bomboniere. So I'm going to give you a party favor. I wouldn't be surprised, though, if many people on this call right now are thinking, well, Christine, I'm still confused because there's so much uncertainty right now with respect to the makeup of the government. And I don't want to act rashly and just throw up a Hail Mary, right? But at the same time, I don't want to be in a position of not acting quickly enough. You know, we're in December. So I would say not only take what Natalie and Henry have provided, but also in the next coming months, keep an eye on the chairs of the tax writing committees. So in the House, that would be Richie Neal. He's a Democrat from Western Massachusetts. He'll be writing all of the tax legislation. He has not at all been vocal about his agenda, so he is somebody to definitely keep an eye on. If the Republicans gain control of the Senate, Ron Wyden of Oregon will be the chairman of the Senate Finance team. He has a lot of ideas about cap gains issues. Specifically, he is a proponent of marking your investments to market and paying the tax as you go. So if he's a chairman, he gets to write the bill. So that's all I have. And I hope everyone was able to pull something useful from the presentation. And I hope we can have some sort of follow-up presentation in the near future once we have a bit more clarity on where the Biden administration is focusing. But until then, I wish everyone a very happy, healthy, safe holiday season and new year.
Thank you, Christine. Natalie, how about you? Would you have some parting advice, parting comments before we go to Q&A?
Absolutely, Henry, and thank you again for having me. Trust the trust. Living in trust is astronomically safer, better, and more effective than living without it. Whether it's probate avoidance, tax efficiencies, or asset protection, a trust gives you all of those things. It's not just for the ultra wealthy. It is truly a fabulous tool from the wealthy to anyone of modest means who has assets and who cares about people and wants it to go directly to them.
Thank you, Natalie. This is terrific. And Amanda, I'm going to turn to you to see if we have any questions from the audience. We are running a bit behind schedule, and we respect everybody's time. We know that it's a holiday season, people are busy. So we're going to take a few questions, and we do promise you that any questions that we're not going to be able to address during this presentation, we'll simply make sure that one of the panelists will get back to you directly via email and address it. Amanda, what questions do we have?
Sure. So we had a few questions come in, so we'll try to get to as many as we can. So one of the questions asked is, can you take back the Slat if you get a divorce or if your spouse passes away before you?
Yeah, so that's the hard thing. We can draft certain provisions in there. However, if you are even smelling a divorce, that's probably not the right strategy. You have to be so secure in your spouse to be, this is a big, big leap of faith, which I guess if you marry the person, it's kind of part of it. But if divorce is on the horizon, this is not the right way to go.
Good point.
Perfect.
Amanda, any other questions?
Yes. So along the same line, someone asked if Slat can be used for beneficiaries other than your spouse.
So the beneficiaries, yes. The whole thing with the spouse, it's the spousal lifetime access trust. However, if someone is either not married or doesn't want their spouse to have any control, then we can do many other kinds of trust that would we would just have a different name, but we would accomplish similar things.
Amanda?
Sure. So one more question that came in is about the 529 education plan and what happens to those funds if the college costs less than the money that you put in. Let's say you did the 5-year 75,000 one time.
So, Christine, would you like to tackle it, or would you like me to take it?
You can take it, Henry.
Thank you, Christine. So 529 is a pretty complex, actually, statute that addresses it. And the last time I looked at it, so I'll be frankly, I'm speaking off the cuff, and if I needed to kind of refresh myself to make sure that there's no regs that say otherwise, but you basically put the money in, you have the growth, you can use it for tuition, and then, if the money is unused, you can also use it for your other relatives for tuition, college tuition. And if that's still not used, there is a way of getting that money back. And there is as I recall, there is a taxability at that moment when you get that money back, of the appreciation of the assets within that plan. Christine, did I capture most of it? That's my recollection on how that.
Yeah, that's the way it works. I think they also extended the use of that, though, to different types of higher educations that were previously excluded. I think they loosened the rules this year.
Yeah, that's terrific.
But they loosened the rules on the type of institution.
So, we're going to wrap up right now. And like I said, to the extent we didn't answer your questions, we will circle back to you directly. I wanted to wish everyone a happy and joyous holiday season. And I really wanted to thank Christine and Natalie for participating on a panel today. They've done a fabulous job. Thank you so very much. Have a great day, everyone.
Thank you, Henry.
Thank you.